There was a standout set of earnings among the Canadian Big Six banks this earnings season. Unfortunately, it was for all the wrong reasons. TD Bank was one of the final three banks to report their earnings this cycle, and while the market didn't just think they were bad, they hated the earnings. The stock finished down 7% on the day of the release, earning TD the title of the worst performance in this earnings season. Why the shellacking? Let's dive in. Okay, so let's start off with the high level. TD Bank in the fourth quarter posted reported net income of $3.6 billion, a 27% improvement on a year-over-year basis from $2.9 billion. Earnings per share improved at an even higher rate, jumping 33% from $1.48 in the fourth quarter of 2023 to $1.97 in the fourth quarter of 2024. On an adjusted basis, however, things weren't as positive. Adjusted net income declined from $3.5 billion to $3.2, while adjusted earnings per share fell from $1.82 to $1.72 as the company was hit with a number of one-time events, including the termination of the acquisition of First Horizon Bank and the settlement of the investigation into the bank's AML program. Even worse for the firm, they were forced to suspend forward guidance as a result of these events, but more on that later. The fourth quarter saw the bank post a return on equity of 13.4%, a strong improvement when compared to the 10.5% ROE posted in the fourth quarter of 2023. This performance was off the back of total revenue of $15.5 billion, an 18% improvement over the $13.2 billion reported in revenue during the fourth quarter of 2023. In terms of analyst estimates, TD, despite the performance of the equity following the earnings release, did not bad relative to analyst estimates. Analysts had called for adjusted earnings per share of $1.73 versus the posted $1.72, and revenue of $13.8 billion versus the actual figure of $15.5 billion. For the full fiscal year, TD Bank saw their net income decline from $10.6 billion to $8.8, a 17% drop. Earnings per share comparatively fell from $5.52 to $4.72 for the full fiscal year. Adjusted net income fell less dramatically, dropping from $15 billion to $14.3. On an adjusted basis, EPS fell from $7.91 in 2023 to $7.81 in 2024. Return on equity fell to 8.2% in 2024, down from 9.9% a year ago, while adjusted return on equity fell from 14.2% to 13.6%. The Common Equity Tier 1 capital ratio also declined, falling from 14.4% to 13.1% as of October 30th, 2024. TD ended the quarter by declaring a dividend of $1.05 per share, a 3-cent or 2.9% increase over the prior dividend. All right, let's get into the guidance, which is basically the reason for TD's rough day following the release of their earnings. TD Bank has labeled 2025 as a transition year, following the events over the last year in their U.S. retail banking segment. The company minced no words in their outlook, directly stating that it will be challenging for the bank to generate earnings growth as it navigates a transition year, advances AML remediation with investments in its risk and control infrastructure, and continues to invest in its businesses. As a result of that statement, a strategic review is now underway for the bank, targeting productivity and efficiency initiatives as well as capital allocation alternatives as the bank reviews their priorities. And with that review underway, the company has cut their medium-term targets, including prior guidance on EPS growth as well as their guidance on return on equity and positive operating leverage. Revised guidance is not expected to be released until the second half of 2025. Moving along here, TD Bank reports earnings across four business segments: Canadian Personal and Commercial Banking, U.S. Retail, Wealth Management and Insurance, and Wholesale Banking. The largest segment, Canadian Personal and Commercial Banking, accounts for roughly half the net income generated by the bank, with the segment in the fourth quarter reporting net income of $1.8 billion and an increase of 8.6% from $1.7 billion in the year-ago period. Growth here was largely attributed to revenue despite slight increases in provisions for credit losses. U.S. Retail is the second largest segment. Despite the quarter seeing a 31% decline in net income on a year-over-year basis, net income dropped from $1.3 billion to $863 million during the quarter, a result of lower revenue and a decline in their share of net income from the investment in Schwab, which is due to a reduced stake in the U.S.-based bank. Wealth and Management Insurance also saw a decline in net income on a year-over-year basis, with net income in the segment dropping from $492 million to $349 million, which is despite segment revenues improving over 33%. A large increase in insurance service expenses negatively impacted the segment's bottom line, with catastrophe claims on the rise. Lastly, Wholesale Banking saw net income improve substantially, climbing from $17 million to $235 million. a result of improving lending revenues and declining expenses in the segment. And finally, we've got the credit losses. In the fourth quarter, provisions for credit losses increased 26%, going from $878 million to $1.1 billion. Provisions break down as a gain of $44 million on performing loans, while impaired loans saw provisions hit $1.1 billion. The bulk of which, or $456 million of, was related to the Canadian personal and commercial banking segment. For the full fiscal year, provisions for credit losses increased from $2.9 billion to $4.25, which was largely a result of impaired loans, which saw provisions increase from $2.5 billion to $3.9. Meanwhile, performing loans actually recorded a decline in provisions, dropping from $447 million to $376. Overall, gross impaired loans as a percentage of the total loan book increased from 36 basis points in the year-ago period to 52 as of the end of fiscal 2024. And despite the terrible year that 2024 was for TD Bank, they are tied with CIBC in terms of the big six banks for the lowest ratio of gross impaired loans. Okay, so let's wrap it up. Was it a good quarter for TD? No, and it also wasn't a good year. We didn't have time to get into it, but the company was hit hard by their settlement on an anti-money laundering investigation, the impact of which is going to be felt for years. A bunch of management remediation actions need to be implemented in 2025 as a result of the settlement. Well, sustainability and testing activities will still be ongoing into 2027, along with a suspicious activity look-back report that has to be completed as per a FinCEN consent order. The bank also has their growth within the U.S. segment capped due to asset limits that have been imposed as part of the settlement. And the bank as a whole is now undergoing a strategic review, not to mention guidance being withdrawn. The bank straight up just isn't having a good time. But that's what happens when you fly too close to the sun and you try to take a solid chunk of the U.S. banking market. Will the good times ever return for TD? Absolutely. They're one of the largest banks in Canada and basically have a license to print money up here. Unfortunately for them, however, our economy is entirely based on real estate and immigration, two areas which ain't doing so hot right now. So if you had to ask me which of the big banks I would want to stay away from right now, TD is probably one of them. All right, everybody, thanks for watching. Let me know what you think in the comments section. This wraps up our coverage on the Canadian big banks this earnings cycle. If you want us to keep doing this, please let us know in the comments section. And if you enjoyed this video, smash that like button, subscribe, and ring that notification bell. Thanks for watching, everybody.